That's been the biggest game changer in the past few years, is really that democratization of alternatives with new product structures, lower minimums to get into these, and really the technology around it that makes it possible for us to scale and do this for our clients.
All right, Chelsea, welcome.
Hi, thanks for having me. I have to say, before we start, who picked these pillows? They're amazing. They're great. So
They're
comfortable.
not. They're uncomfortable. I recommend you actually have a pillow on your chair as well, right?
I do.
What's it say?
I have one on my desk chair that says, I could agree with you, but then we would both be wrong. My sister got it for me for my birthday, so she felt it fit very well.
I think...
I feel left out. I need to get a pet pillow or something.
Your birthday is not that far away,
I know.
so we can go in on one for you. That can be
Tom,
next on the birthday list.
Trust me, one will be on its way. Just wait. So, Chelsea, you head up our alternatives division. We're chatting about all things alternative today. We've got a lot of volatility going on in the world today, and alternatives can really help with that. Do you want to maybe paint a picture of the world of alternatives, how it kind of breaks down, and where some of the benefits can come into play for most clients, investors, broadly?
Sure. Yeah, and alternatives can mean a lot of things, right? There's crypto, there's investing in art, collectibles, wine, bourbon, all of that. I'm sure, you have quite your own
Don't
collection.
forget cigars.
Yes,
Don't forget cigars.
I was going to add cigars.
Yes.
All of that. So it can range, buying land and property, all of that. But really, there's also where we're focused a lot, and I'm focused, and our team is really on the private equity, private credit, infrastructure, private real estate segments of the market. And, traditionally, when we've talked about our clients' portfolios, it's been thinking about allocating to public stocks and public bonds. And we're really just finding that adding these private market investments, are really a way to lower volatility in portfolios and also increase risk-adjusted returns in the long run.
So private equity, public equities, I think I can kind of draw a distinction. One's public, one's private. Assuming they all do about the same thing, why do they perform differently? How are they better?
I wouldn't say better. I mean, they're different, and you want them to be different. And I was talking to someone on the team actually this week and saying, with all the recent market volatility in the public markets, that we really know that over the long run, we're going to get to, we know the long-term average returns in each asset class, whether it's public equities or private equities. But there's not so much drama in between when you're looking at private markets, just as it's longer holding periods. They're not being traded throughout the day and getting marked at the end of each day. So that smooths some of the portfolio returns and lowers volatility in these client portfolios.
How do you go about selecting what alternative investments are suitable for our clients?
Yeah, manager selection is so important, and doing due diligence on these managers is probably one of the best things you can do, or you need your financial advisor to do. I came from a more institutional background, and you referenced earlier, I think that institutional investors were really the ones historically using these. It's so important to make sure you are doing due diligence on these investment teams, understanding their track record, making sure they're really the best athlete in the space on the strategy that they're trying to implement, and then also the operational and the compliance due diligence to make sure that this is a fund that runs well and is going to take care of their investors. And we work with third parties to do initial reviews, and then our team in-house and our investment committee does an additional layer of due diligence to make sure there's multiple sets of eyes on these managers before we're even considering presenting them to our clients.
Sounds like a lot of vetting.
A lot,
Yeah.
yes.
Draw a distinction of when you might use, let's say, public equity or private equity or private debt in lieu of kind of the traditional allocation to equity or fixed income. Take an average retiree Does it make sense for everybody? Who doesn't really fit the criteria where that might be appropriate for them? And then most importantly, I'm the devil's advocate. Tell me the pitfalls or downfalls, because it sounds great, but usually there's a reverse side to that coin.
There's a catch?
Yes.
Well, really, take private credit, for example, compared to investing in public market bonds. One of the main risks you're going to think about in all private market investing is a lack of liquidity. So if you are working with a client that really has high income needs for their portfolio, but not short-term liquidity needs, that's where private credit might make a lot more sense due to the higher returns and some of their floating rate in nature, typically private credit investments. So you get some interest rate. You're not as sensitive to interest rates, I should say. So you get some insulation there. And then the clients are getting that income they need, adding the diversification.
And not an all or none situation. It could complement more traditional fixed income investments. So
Yes.
and because I know you focus on the denominations, the size of the investments can be relatively small, so they can have many different types of private debt and investments. It's not just one or the other.
Absolutely. That's been the biggest game changer in the past few years, is really that democratization of alternatives with new product structures, lower minimums to get into these, and really the technology around it that makes it possible for us to scale and do this for our clients. So it is something not to be done in lieu of public markets, and every client is different, but it's definitely a great complement and something to consider if it's right for their portfolios.
They each might have their own niche or specialty, so they're trying to create a portfolio where they don't have overlap, for example, in private debt. By having a couple of different diverse providers, you're creating a more balanced portfolio.
Absolutely. We really try to be thoughtful in our manager selection, where if an advisor on our team is working with a client and thinks private credit is right for them, that we have multiple managers that are looking at different segments of the market, looking at upper core or lower middle market, doing, there's sponsor back lending, there's non-sponsor back, and then even within it, there's alternative credit, distressed investing. There's all sorts of things within private credit market itself that managers can specialize in.
Now, I focus on liquidity. That's one of the first questions I ask before I even return. Are these maybe not as liquid as public securities, but they're still relatively liquid?
So it depends on the fund structure that the manager offers. So a lot of the funds that we have available and are currently working with are more evergreen in nature. So that gives, I would say they're semi-liquid is how I would refer to it. So it's not something that, like with your public bond, that you can just sell at the end of the day and, not worry about. It's going to take a little bit of time, but it's not of a typical drawdown fund that we used to see historically in private markets. You're not locked up for the 7 to 10 plus years in these funds.
I heard a lot of good things. I still haven't heard what I'm looking for. What are some of the downsides of alternative investing?
Well, Don, I think we did cover a little bit of the downside with the liquidity. The
All
lack
right.
of liquidity
All
is
right.
a potential, downside or risk if the circumstances change
Okay.
for an investor. Also, the manager selection. If you're not selecting a good manager that is doing a great job underwriting these businesses before making those loans, that's a huge risk. And not properly diversifying across sectors and what their exposure is. That's something with the tariffs recently announced. I've been working all week with our private credit managers to understand really what their exposure is in their portfolio, what they think could potentially be hiccups along the way, or how they're working to mitigate on that. So that's why working with great managers is key.
Yeah.
Now, because these are not complete liquid or relatively liquid, the clients expect a slightly higher rate of return or distribution rate than maybe a more public debt.
Absolutely. The clients would absolutely expect to be compensated, whether it's private credit or private equity, to be compensated for that lack of liquidity tying up that money. So we do see higher returns, typically in higher higher yields in the private credit market versus the public markets.
Are they generally less correlated than to the equity markets than more traditional fixed income?
Yes, we've absolutely seen a lot less liquidity. Honestly, over the years, when you look at a 60-40 portfolio and you were diversified, if public market went up, or the stock market went up, the bond market went down. Now we're really seeing a lot more correlation between those two markets. So the private investments is a really great way to truly add that diversification.
Well, it sounds pretty good.
It can be.
Yeah,
It can be.
Yeah, I appreciate that. So tell me, I know it's been democratized and it's now available to a wider audience. Is it available to anyone, or are there certain criteria that people need to have in terms of net worth, income, other aspects to be able to even qualify?
Yes, absolutely. There's every fund and manager has different qualifications based on what the underlying investments will be. So that's something our advisors really work with the clients to understand, what is their, there's accredited clients, accredited investors, qualified clients, and qualified purchasers are the three different levels based on risk. And it's based on their either knowledge of the markets or licenses and whatnot, but also their income and net worth to help understand the amount of risk they can take in their portfolio. So qualified purchaser would be the biggest hurdle to meet for some of these funds. But we tend to look across managers and try to make sure we have a variety of funds looking at different things. So we have managers on our platform that we've approved for our platform that are for accredited clients or qualified purchasers.
What's the difference in terms of accredited and qualified? Is there a dollar figure or a number? What does that look like?
Man, I gotta get my SEC website out and get the exact
I need
definition.
details. You know me.
Accredited investor is a lower hurdle. There's a income hurdle for it, and I won't quote it
It's
for
like $200,000.
Okay, there you go. I'm not the client facing one going through. Or there's also on that, if you have certain financial licenses, you're considered a financial investor or a accredited investor, even if you don't meet the income criteria or net worth criteria. While on the other end, qualified purchaser is a $5 million net worth for individuals. There's different things for various types of trusts or corporations that might be investing. There's different hurdles to meet, but it's a much higher hurdle for a qualified purchaser.
Back to liquidity, are there any other limitations? Like, are there soft lockups or hurdle rate, or gates as far as when clients want to get out?
Yeah. So I would, to Don's point, there are another, potential
Okay,
thing
Don.
to
There we
see.
go.
And
Thank you.
yes,
You know me.
Good point.
We're going to make sure we
appreciate
have to
it.
discuss all the risks and pros and
Yes, there you
cons.
go. No, I get it. So these investments do typically have higher fees than what we see in public markets. And that's for a good reason. It takes these companies, they're doing a lot of work underwriting these credits and going through, and they want to be compensated for the work they're doing to get those higher returns. So these funds, it can range by fund and whether it's evergreen or drawdown, but they do have higher funds. And a lot of times they do have either hard lockups, or which are typically, if anything, like up to a year, it depends on the fund, or soft locks where they'd like you to stay in, but if you do need to get out earlier, there's like a small penalty involved. But then they also, on the fees, they will typically have hurdle rates, and a lot of funds, not all, but I will say a lot of funds have hurdle rates where you aren't paying a performance fee on those returns until they have hit a certain threshold of return for all their investors.
Yeah, but they also, don't they have things where the limited, like a certain percentage could liquidate any quarter?
They do usually have gates as well. And that's really, I know people think of it, and it is a downside or a risk that they'll a lot of times say we could gate the portfolio up 5%. So say everything was going wrong in the world and everybody's trying to get their money out all at the same time. They'll say we're only gonna give back 5% of the money from this. So it could take you many quarters, right, to get out of those investments if that was happening, or just multiple quarters, depending on how many people are trying to liquidate. But I also encourage people to think about that as a feature, not a bug, right? Because it protects the people who are staying in it, and it protects your investment. Because if they're having to quickly get out of these investments to give money back to their clients, the value goes down
Fire
very
sale,
quickly.
right?
It's
A fire
absolutely
sale.
a fire sale.
It is
so
actually safe.
it is for
Right.
your protection.
I think it's better for it because otherwise they're selling securities maybe at fire sales and not getting the best price. So people
Absolutely.
don't want to get out are actually being penalized by the other people getting
Absolutely.
out.
I think that happened in the great financial crisis where there were a lot of gates that people hit. And while it felt uncomfortable at the time, having a recovery and being able to liquidate at higher prices protected a lot of people, I'm sure.
But no, the amount of people getting out any quarter for most providers is very low. I mean, so it's a pretty rare event. But I think it actually in the best interest of the clients that there is some type of gate to prevent a mass liquidation in any one quarter.
Absolutely. And I really think that's a good point to encompass really the illiquid nature of private markets in general of sure, talk about it as a risk. But a lot of times when we have things going on in the public markets, like we've seen recently, and people, investing is very emotional, right? You see this happening, you think, I want to get out, I want to go to cash, I don't want to be exposed to this. And, we get those client calls all the time. And we know, just looking at history and looking at investing, we know that staying invested and not trying to time the market, no one ever times the market well, and certainly not multiple times. So we know clients we almost want to save them from themselves, right? And not do it. So sometimes the lack of liquidity with private markets is a feature, not a bug in
Sure.
that way,
It
because
can
it is hard to get out.
protect people from themselves.
Right.
So we
Because
would-
by the
Yes.
time you could get out, even if it's a more, a fund that is semi-liquid, by the time you might be able to do that and hit the filing and request your money back, maybe things have settled down. It might be you're not doing
You know
those
what?
shorter term reactions.
Thank you. That needs to be a future topic. Just investor psychology.
Absolutely.
Because there's so much to unpack there in terms of helping clients, in terms of protecting them from your own innate tendencies when markets decline. Oh, I need to be out.
Yeah. Behavioral finance is fascinating. It would be a great podcast topic because, the little bit I studied it through the CFA exams, it is really, and it's hard. Like even studying it, taking the exams and knowing the pitfalls and things to avoid, it's hard when I look at my own bank account or, my portfolio on days like we've seen recently. It's a hard thing to see and stop yourself from making those bad decisions.
And so circling back to alternative investments, your perspective is alternative investments can help clients through times like that and through the upward bias the market traditionally has.
And we've also just talked about private debt. Do we want to touch on private equity?
Sure.
I mean,
Yeah.
that's a completely different animal.
Yeah, you're really going in and not making loans to these private companies, but these private equity firms are going in and they're investing with the goal of providing capital for these firms that are growing and need to scale and giving them the capital they need and they can take part in that growth. A lot of times, like when you're investing in public stocks, or it might be a buyout strategy where they're going in and they're trying to take a controlling interest or even take full control of a business and then add some operational improvements and with the hopes of eventually selling the company to either another company or another investor or potentially through an IPO in the public markets.
Interesting. So as you look at private equity and or getting back to private debt in a typical, and I know there's no typical client or investor, but you have someone who's retired that has means, a $5-10 million portfolio. They've got income. They've got all of the attributes that one looks forward to in hoping for successful retirement. What kind of allocation makes sense?
That's really hard to say because, like you said, no two clients are the same. But I do think that for the vast majority of our clients and, looking through our client base, as we implemented alternatives internally, that most clients in that position can withstand a 10 to 20% allocation across private markets.
Okay.
And private equity has much different holding period than a private debt, where we're talking liquidity. There, you really are trying to give up liquidity to get potentially better returns.
It really depends, and that can come down to the fund structure. We are seeing more evergreen, semi-liquid vehicles on the private equity side, which I'm watching. I think, private credit lends itself more to an evergreen vehicle because there's consistency in loans and there's income coming back. But there is a lot to be done in areas within private equity where we're seeing more of that, especially within secondaries, which is an area that I like a lot. And that's whether it's LP-led or GP-led secondaries, it's buying someone else's interest in a private equity investment. So a lot of times we've seen, these pensions, endowments, and foundations, they have very tight, investment policy statement that they have to be allocated, a certain percent to different asset classes. So when we see big shifts in the market, like recently, when all of a sudden now their public market equities side of their portfolio is down in a smaller percentage, they look incredibly overweight to private equity. And so they have to sell that allocation and to meet those standards. And there are secondaries firms that will go in, and we have a few managers we work with there that will go in and buy their stake, typically at a big discount because of that lack of liquidity. It's not a tradable market like the stock market. And it's actually to their benefit because they look in and it's, maybe they're 4 years into the 7 to 10 year period you're expecting, and they've already seen how some of the assets have performed.
Better visibility.
Right. They have more visibility into the underlying investments and how their confidence in the returns that the manager was hoping for at the time they initially invested. So they buy them at a discount, and then you get to realize that over time. So there's a lot of managers like that we think are, especially in a market like this, are, hopefully poised to do well.
Excluding the secondaries, what would you normally tell a 5, 7, 10 year potential holding period, for private equity?
Most drawdown funds are going to be, 5 to 7 up to, 10 year, that they're going to draw money over, 4 or 5 years and then start returning it. But you shouldn't expect to have all of your capital back until maybe 10 or 11 years from the time you initially invested.
And that's why they potentially offer better returns.
Absolutely.
Mm-hmm. And I know, Tom, you'll like this aspect. Deploying capital into private equity, you don't want to do just one single allocation one time. There's something called vintages, and I know you're a wine guy, and vintages are important in wine. How are they important in private equity?
Yeah. Vintage investing and doing this, we do this a lot on the institutional side. You want, just like every year is different in the stock market, every year is different in the private markets and different opportunities and that they have for investing. So you would typically stagger or, deploy your investments over multiple years to get that exposure. But that is, again, I would say another value of something like secondaries, where those managers will look at buying those investments that have exposure to multiple vintages, so you get that increased diversification right off the bat. I would also say that the evergreen and the semi-liquid funds that we've talked about, that eliminates a lot of that because you are lowering that J curve exposure off the bat. You're fully invested.
J curve?
The J curve.
What,
yes.
What's a J curve?
There we go. So a J curve is when you commit, say $500,000 to a private equity manager. That's going to be drawn. That's not drawn on day one. You don't sign the paperwork and then say, here's my $500,000, have fun. They're going to call your capital over time, over several years. And so that J curve is that you're going to see a time where money is just going out. And so that's almost a negative return there, right? And then
it's kind of like being married with kids, just money
yes,
going out.
Yes, money out the door all the time. Paying for daughters' and sons and all their sports. Yes, a lot of money.
Were weddings, Tom?
Or weddings, yes, that's a lot of. I was at something with Tom recently, and someone said they compared paying for a wedding to buying a really expensive car and then just driving it off the cliff the first day you got it. And I thought that was a great way to talk about that.
That's pretty
compare that.
romantic.
Yeah, that's great.
My favorite line now is that I gave my wife and daughter an unlimited budget, and they've exceeded it.
Oh man. Well, where were we?
Yeah, we were talking about J curves.
Yes, sorry. Sending out money and not getting any of it back now.
Yeah.
So you're initially sending money out, but like we talked about, the investments in these companies are longer, right? They want to invest in these companies, give them the time to make improvements and sell them at a profit. So it takes a few years before you start getting money back and those returns start turning positive. So that's the J curve. And that's something that advisors really need to manage. And that's the benefit of working with an advisor, to manage that for your portfolio and thinking about where you're exposed. But the evergreen, that's one of the benefits of these, newer evergreen structures that have come to market, because you're invested fully on day one. It's into a fund. It's great for the clients and the advisors that you're putting that money in, and you know what it's doing. You have strong diversification across multiple funds, multiple years, a lot more
So
investments.
you don't have a J curve; you have more like an I.
There's no J curve. It's more equivalent to what we're used to with putting it in an ETF or a mutual fund.
And these are pooled, where they have multiple investments in the pool, and they're investing slow in different, over time. But we, for more aggressive investors, we do have single company investments, or single they can make, but they're much more speculative.
Yes, yeah, that would be more. And we're really focused on managers that are
Well,
keeping things
pooled,
really diversified.
which is better for
and,
the average client.
Yeah, absolutely. Absolutely.
Well, wow, we've covered a lot today. A lot of technical terms: J curve, drawdown, gate, LP, GP. Probably is pretty confusing for a lot of folks. What's the easiest way, if people want to know more about this, what's the easiest way for them to get in touch?
I think that if you want to know more and understand if it works well in your portfolio, to visit our website in the link below and hit subscribe when we talk about more of these topics.
All right, guys, I think that's a wrap on alternative investments, expensive weddings, a lot of other things.
Pillows.
Pillows,
Yes.
We've covered the gamut.
Yeah.
I think.
All right.
I got to go order Tom's pillow for his birthday. Yeah.
Fantastic.
There you go.
All right. Well, thanks for joining us. We look forward to seeing you in future editions